Welcome to Finbot Insights. We're here to deconstruct institutional research for you, the modern investor. Today, we're diving deep into the 2026 investment outlook, and what we found is a complex picture hidden just below a seemingly calm surface.
So what's the central story for 2026? It really boils down to one major tension. On one hand, you have a market that looks surprisingly resilient, propped up almost single-handedly by the AI revolution. But as this image suggests, there are some serious weights: sluggish growth, tariffs, mountains of debt, brewing just out of sight. It's a precarious balance, and navigating it will be absolutely critical.
All right, to really understand the markets, we have to start with the big picture. Let's establish the baseline economic forecast, because this provides the foundation for our entire analysis. Now, 2026 is not projected to be a smooth ride. Think of it more as a cold, hot, and cold again trajectory. Things will likely heat up in early 2026, with GDP growth jumping above 3% as tax refund stimulus hits the economy. Then comes the cooling period mid-year, where inflation is expected to peak just under 4%. But by late 2026, we're back in the cold, with growth slowing to between 1 and 2% as that stimulus fades away.
The structure of the economy itself reveals another crucial detail. This is not a uniform recovery where all boats are rising. It's what's known as a K-shaped expansion. Imagine the letter K. One arm goes up, the other goes down. That's a perfect picture of the economy today. High-end households benefiting from wealth effects are on that upper arm, but middle and lower-income households are on the downward arm, getting squeezed by inflation and slowing job growth.
This division extends all the way to the Federal Reserve, which is caught in a serious tug-of-war. You have the hawkish camp, which sees inflation still above target and argues for extreme patience on rate cuts. Then you have the dovish camp, which is looking at the slowing labor market and arguing for more easing to protect jobs. This internal split means the Fed will likely follow a very shallow and cautious path, creating a persistent source of potential rate volatility.
Okay, that's the macro backdrop. Let's turn to equities and address the million-dollar question. After 3 consecutive years of double-digit gains, are we in a sustainable boom or a speculative bubble that's about to pop?
Let's be direct. The market's performance is deeply tied to the single theme of artificial intelligence. And anytime you see that much concentration, you have to rigorously scrutinize it to determine if it's built on solid ground or just speculative excess. And here's where the story gets really compelling. Unlike past bubbles, this cycle is being financed by cash-rich corporations making massive, tangible investments. Just look at these numbers. We're talking about cloud capital expenditures jumping from $258 billion in 2024 to a projected $588 billion by 2026. This isn't just speculation. It's a direct response to robust, monetized demand. This is the construction of real infrastructure. Of course, strong spending is one thing. But what ultimately justifies valuations is sustainable profit growth. So the durability of corporate earnings is the next critical piece of this puzzle.
And when we look at the data, we see that K-shape again. It is truly a tale of two markets. For the Magnificent Seven tech giants, consensus earnings estimates for 2026 have been revised up. But for the other 493 companies in the S&P 500, those same estimates have been revised down. That long-awaited broadening out of earnings growth beyond big tech, it simply hasn't materialized, and that concentrates a significant amount of risk into a very small number of stocks.
With the U.S. market narrative so concentrated, it begs the question of where else to look. While major structural shifts are making a powerful case for looking abroad, and this could be a significant pivot for investors in 2026.
Take a look at this number: 1,520 basis points. That's 15.2 percentage points. It's how much international equities outperformed U.S. equities in 2025, the largest gap since 1993. This was not an anomaly. The research suggests this was a signal of a fundamental shift that has further room to run.
So, what's behind this shift? There are 4 enduring themes, which you can remember with the acronym PASS. First P for positive nominal growth. The end of negative rates has transformed the earnings power of companies in Europe and Japan. A for the AI theme broadening globally. S for spending, as foreign governments commit to major domestic investment. And another S for shareholder focus, as buybacks go global. Together, these themes build a compelling case.
All of this leads to a crucial strategic pivot. The changing dynamics of the market demand that we fundamentally rethink portfolio diversification. The old playbook is fast becoming obsolete. So let's be clear. Diversification isn't dead, it's just different. As the markets evolve,
The very principles of portfolio construction must evolve with them.
And here's the problem. This chart shows that the average investor's positioning is completely offsides. Years of chasing U.S. growth have left portfolios dangerously concentrated, overweight U.S. growth and cash while being dramatically underweight foreign equities, U.S. value, and bonds. That is a precarious place to be when the game is changing this quickly.
So what is the final verdict? Our analysis of the economy, of equities, and of global opportunities all distills down to one clear strategic takeaway.
The primary mandate for investors in 2026 is simple: get back on sides. That means deliberately rebalancing portfolios to reflect the new realities of global markets, the real income potential available in bonds, and the evolving face of diversification.
Now, we must be absolutely clear. This analysis is not financial advice. It is a distillation of research for informational and educational purposes only.
In fact, let me be even more direct. Do not trust us. Do not trust social media influencers. Your financial future is your responsibility and yours alone. It requires your own due diligence and your own independent research. Always consult with a qualified professional before making any investment decisions.
If you value this type of sharp, data-driven analysis, please support Finbot Insights by clicking the like button and subscribing to the channel. Your engagement allows us to continue deconstructing complex topics to empower your investment journey. Thank you for watching.